Welcome, ladies and gentlemen, to the Coin Republic podcast. My name is Shora Bacharya. Zero knowledge proofs, rollups, snarks, starks. These are all complicated topics for the uninitiated. So, on this episode, we will try to simplify it all, dial it down for everyone. And when I mean everyone, I mean the investors, the retail investors, the institutional players, everyone. Just like always, make sure you like, share, and subscribe the video and support the TCR podcast. Today, I have the honor to be joined by the CEO and co-founder of Zklend. Zklend is an Layer 2 money market protocol built on Starknet, combining zk-rollup scalability, superior transaction speed, and cost savings with Ethereum's security. The protocol offers a dual solution, a permissioned and compliance-focused solution for institutional clients, and a permissionless service for DeFi users, all without sacrificing decentralization, the holy grail of Web3. So it is my honor to introduce you guys to the screen with the one and only Madam Jane Ma.
Hi,
Welcome.
Saurav. Thank you so much for having me, and that was such a kind introduction.
No, and when we first got in touch, your profile seems so fascinating. So let's just dive right ahead with your background. You worked in Credit Suisse and have a vast experience in the other fields except for DeFi. So what made you switch to blockchain and cryptocurrency?
Yeah, absolutely. I think my background really is one that illustrates the story of someone who comes from a traditional finance background, then went to a startup world, and then went into the blockchain space. But a very quick introduction about me. I'm Jane, and as Saurav mentioned, I'm one of the co-founders for Zklend, which is a lending protocol that is built on top of a layer 2 solution called Starknet. The reason why Zklend actually started in the first place was really more by chance than anything. I had been working at a company called Deliveroo for some time, and really that business focused on food delivery. And prior to that, I had worked in banking, and both of these jobs really gave me very, very different skill sets. At Credit Suisse, it was all about joining the analyst program, really getting trained up in some of the more traditional or some of the more cookie cutter skill sets that have benefited, that have given me a lot of structure in my thinking. And my job at Deliveroo, although it was at a startup, I saw the company really evolve from being a small scale food delivery company, especially in Hong Kong, into, I wouldn't even call it a startup to this day. And what it has given me is a very much boots on the ground, firefighting mentality, do whatever it takes to get done. And this very much contrasts itself to my previous job, which is very well defined, and it was very clear in terms of what my career trajectory looked like. So, putting two and two together, I realized that there were two things I loved. One is I love giving structure to things, and that's really from my experience at Credit Suisse. And I do love learning about markets and economics because that's really where my background is from. But the second part of what I learned through my second job at Deliveroo is really I wanted to do something that had an impact, had a visible impact in terms of my day-to-day. And so I was very fortunate, after 4 years at Deliveroo, the company IPO'd, and when I was looking for my next challenge, I came across, a professional opportunity in DeFi alongside Jonathan and Brian, my two co-founders, who were looking to start something at the time. So I'm definitely the latest joiner in the space, but I think what I do bring to the team is my startup mentality and really my strategic mindset.
All right, so Zklend, as you mentioned on your website, you combine zk rollup scalability and security of Ethereum. But as we all know about blockchain trilemma, security, scalability, and decentralization, how is Zklend working towards solving this trilemma?
Yeah, I mean, a couple of fold. I would say, we're definitely not going about it alone. We're definitely leveraging a lot of the technologies that we believe in and doubling down on that so that we're trying to build a product on a technology that we believe is going to be the future of blockchain or even future of any type of transaction or finance. Anyway, so when we talk about the blockchain trilemma, we have security, scalability, and decentralization. And to start with the first point, security, it's all about obviously blockchain security. And for us, we believe that Ethereum is kind of the ultimate blockchain solution, given its both secure and decentralized properties. If you look at the number of nodes running on Ethereum versus on some of the other L1s, you will see that Ethereum is a lot more decentralized than a lot of other networks. Now, that being said, if you have experienced DeFi summer, as well as, a couple months ago, the Pepe meme coin that really brought trading volumes up, what you will realize is that transacting on Ethereum can often be quite expensive. So basically what you're trading off is you're getting security and decentralization, but you're not getting cost optimization. And that often means that retail users, such as myself, and maybe you, Saurabh, we're often the ones that are suffering because we're the ones that are priced out. For institutions that are making trades of $1 to $2 million, maybe a gas fee of $50 wouldn't necessarily matter. But if I'm trading something that only costs $100, paying $50 gas fee is already 50% of my entire transaction value. And that is often detrimental and often could prevent people from engaging on Ethereum. And so, enter zk-rollups, and in fact, enter any type of rollup solutions a couple of years ago, when Vitalik said that rollup solutions are in fact going to be, or zk-rollups are going to be the ultimate scaling solution for Ethereum, we realized that what we could do is we could leverage the properties of Ethereum. And there's this awesome thing that is coming out that will, on top of that, add scalability onto the network. And so what we believed at the time was, rollup technology, there's obviously optimistic rollups and ZK rollups. But what we believed is that while optimistic rollups are great, and in fact, implementation times are often faster, as you have seen with Optimism and Arbitrum. But what often happens is that, ZK technology is a lot more complex, but you're guaranteed by math and not people. There's obviously a proof that comes with there's a proof that comes onto Ethereum L1, and all of your transactions are proven by math and not by trust. And so for us, what we believe is that we want to build for the long term. And that's how we landed on building on a ZK rollup network.
That is fantastic. And, I understand from, the expert's point of view, how important layer 2 solutions are, and especially ZK rollups in terms of, getting a faster and scalable solution to our transaction problems, right? But for the uninitiated, for the people who are going to watch this clip, the shorts part, could you explain what ZK rollups are? Let's dial it down a lot.
Yeah. Maybe I'll just start with what rollups are, and then I can dive into the difference between optimistic and ZK rollups. Rollup solutions, if you think about it, instead of taking a cab to a really congested area, what you're doing is you're gathering a group of people and putting them on a bus, or you're putting them on a train and putting them onto this fast track that basically bundles everything up so that everything is more efficient. So maybe that's not great for the short clip, but what it really means is it just compresses all the transactions into one single proof. And what you're able to do is, instead of going transaction by transaction, you're able to condense thousands or hundreds of thousands of transactions and send it over onto layer 1.
Okay. And how is it compatible to particular layer 1s? Do we have ZK rollups, in particular, like we would definitely talk about Ethereum quite a lot, but other layer 1 blockchains, could you give us an example of ZK availability in other layer 1s?
Yeah, I think ZK rollups are definitely not exclusive to Ethereum. In fact, the idea of ZK, zero knowledge proof, is not something exclusive to the blockchain. The idea of zero knowledge is just to be able to prove something without revealing the actual secret. So an example would be, I went to the gym and I want to prove to you I went to the gym without recording a video of myself working out, because maybe that's embarrassing. And so what that really means is, ZK technology can have multiple applications in the world of blockchain. One is in terms of scalability, because you're able to compress a ton of transactions into one proof and send it over in a compressed manner. But the other part of ZK technology is actually about privacy. And as I mentioned, zero knowledge. What that means is I don't want to reveal any part of what's happening in that transaction to you, but letting you know that that transaction has taken place. So I know it's very compact in terms of the information that I'm trying to convey, but I think if there's one thing you're trying to take out of it is, zk rollups offer two types of solutions in the world of blockchain, and it's not exclusive to Ethereum, even though it's most developed in the world of Ethereum. One, it offers scalability, so probably needs no more explanation, but a lot of transactions can be processed simultaneously in a very fast manner. But the second part of it is privacy, where users' transactions can stay anonymous.
Let's move to the second part. I visited Artemis recently, and the annual per yield looks quite lucrative. I'm sure people want to know about the project a little bit more. So, would you shed some light about Artemis project?
Yeah. So we haven't have had an update. We have had a rebrand recently. So maybe I'll start with what Zklend offers. Our project at its core, we do lending markets. And the idea is we want to cater to both retail and institutional users. So for the retail users, we have a protocol called Zklend, and it was previously called Artemis. And what it really does is it allows anyone to seamlessly connect their wallet, deposit, and earn a yield on the assets that they're depositing. At the same time, they're able to use those assets as collateral to borrow other assets. So whether you're using it to hedge a position, or if you want to leverage on a position, for example, if you think Ethereum is going to go up, maybe what you do is you want to leverage long, for example. These are all things that you can do with the Zklend protocol. Now, on the other hand, we do have another protocol called Zklend Institutional, and that one is not yet live. But the idea is it offers the exact same functionality as Zklend, except it's catered to institutions. And what we know is that institutions often want predictability as well as compliance with a lot of the financial activity that they're doing. So we do plan to add a KYC layer onto Zklend Institutional, so only KYC individuals would be able to use the protocol. But on top of that, we do want to add product variation. And what that means is currently our Zklend offers dynamic interest rates adjusted by supply and demand. But oftentimes, the fixed income world is what institutions genuinely care about. So that's the area that we do plan to focus on for the institutional aspect.
Right. Let's expand on that. Institutional clients. So Zklend
Yeah.
also offers a permissioned compliance focused solution for institutional clients in particular. So can you talk about it a little bit, about more like the institutional services that you provide?
Yeah, there's two folds to it. The product is not yet live, and it's probably going to come around in mid 2024. So we are still in the development phase. But the idea is if you are a market maker or if you're a VC and you need funding, and previously people would go to Genesis for this, right? And obviously they've gone bankrupt since. And the problem, actually, just to take a step back, the problem with a lot of institutional lending is what they might do is if I'm Three Arrows or if I'm Alameda, I might just call up the Genesis desk and say, hey, I need $100 million in loan. And I'm going to pledge X amount of collateral. All of this information is, in my mind, pretty arbitrary because it's not transparent. I don't know how much Genesis has lent out to different counterparties. I don't know the rate at which they've offered this loan to other people. And I don't even know what the payment schedule looks like because it's private. It's a private transaction between two parties that may or may not happen on chain. I don't know because I don't have visibility over it. But the idea of Zklend Institutional is that it basically takes this business and it puts it on chain so that there is some kind of trust assumptions that are embedded into this. So if I am hedge fund ABC and I have $100 million I want to borrow, what I might do is I might use Zklend Institutional and I might open a borrowing pool. And there are two ways to look at it. Other lenders could supply to hedge fund ABC based on the going rate, or based on the supply demand, we can determine what the borrowing rate looks like. But the other side of it is we can set a rate that is benchmarked to the market, and based on demand, ABC, hedge fund ABC, will be able to raise X amount of money. So there are different variations to it. It's very much like a fixed income model or a deposit model that you're looking at. But fundamentally, what we do want to do is we want to offer these instruments to institutions that are not limited to backdoor deals.
It's interesting because you are Zklend. Would you identify yourself more as a layer 2 platform or as a DeFi platform? And on that note, could you clarify if all DeFi platforms are layer 2 or something else?
That's a really tough question to answer. I think if I had to choose one, I'm not even going to try, because I would say we are both a layer 2 protocol as well as a DeFi protocol. We are a DeFi protocol that happens to be built on a layer 2 network. Now, in the future, would we go on to a layer 1? Maybe, but I don't think so, because we are focused on ZK solutions, as our name suggests. So more likely than not, we're going to be focused on layer 2s, or maybe even layer 3s. But I do think it's really interesting you bring up this point, because if I think about the likes of Uniswap, SushiSwap, Trader Joe, and in fact, a lot of DeFi platforms, they are deployed across so many different chains that I would first and foremost identify them as a DeFi protocol. However, you also have DeFi protocols that are strictly deployed onto one chain. For example, Zklend, Benchi, Venus, I believe that they're only on BSC. And in some ways, I more so identify them with the chain than I do identify them with DeFi.
That is fantastic. Well, Zklend's market pool design says higher risk assets will be placed in an isolated market for risk contaminant. So, won't the high volatility push for higher liquidations or higher collateral for the users? Could you explain that a little bit?
Yeah, definitely. So maybe if I start from scratch, the reason why we decided to eventually, it hasn't been implemented yet, but it's on the roadmap, implement isolated markets, is because we have seen time and time again, as we have seen with the Curve and Aave saga just a couple of weeks back, that there are certain assets that should not necessarily belong to a core pool, just given its volatility. Because what that means is if that asset price tanks, or the oracle gets exploited because there isn't enough volume or things like that, that could jeopardize other positions that are sound in the protocol. But at the same time, we're all about composability in the world of DeFi, and we want to make sure that certain assets, however volatile they are given composability so that you can use those as collateral to borrow other assets. And so this is where the concept of isolated market comes in. We want to offer composability without jeopardizing core pools like Ethereum, Bitcoin, or wrapped Bitcoin, USDC, and USDT. And the idea of isolated pools ultimately is we want to offer these pools. Maybe it supports the likes of Stark token within the Starknet ecosystem, the Argent token. By the way, none of these tokens are live yet, so please do not take this as a sign that the tokens are live. But we want to support ecosystem tokens. Let's just say I have some Starknet tokens and I want to borrow USDC with it. Maybe then what I would do is I would pledge it into this isolated market and borrow USDC. Now, of course, the risk parameters are going to be a lot different than the risk parameters in a core pool, just given the volatility of a Starknet token. Because if the time comes when something happens to the Starknet token, liquidators need to be able to liquidate the loans quick enough and be able to earn a sizable profit to incentivize liquidations so that there isn't bad debt in the pool. And what that means is it's so that the lenders of USDC in that particular isolated market doesn't get burned, for lack of a better term.
All right. On that note, let's talk about your native token, if we can categorize that as Zend. When is it going to launch? and when can people participate in its pre-sale?
Yeah, that's a great question. We have actually made no announcement of the token launch yet. Ultimately there will be a token because in the world of DeFi, we do rely on a token to be able to incentivize different types of activities on the protocol. And what I mean by this is, for example, if there is a pool that is highly utilized, like, I don't know, everyone wants ETH and everyone wants to borrow ETH, but there aren't enough deposits because maybe everyone's gone ahead and staked their ETH somewhere else. Maybe what we would do then is we would use the Zen token mechanism to incentivize deposits so that we could ultimately make sure that people are able to borrow. Now, that was not a great example because the next thing I do want to say is the way the token is designed and the way our pools are designed is we ultimately want to incentivize revenue generating activity. And revenue generating activity here stands for borrowing activity because that's how the protocol ultimately makes money. But in short, really having the Zen token as a lever for distribution rewards is how we will ultimately incentivize the right types of activity in the protocol.
So we talked about isolated market contaminant for high risk assets. Artemis offers a dynamic interest rate model which depends on the market utilization ratio, right?
Yeah.
Utilization ratio depends on the borrowings. So won't a large amount of, affect the interest rate and change the structure? Can you please explain that a bit?
Yeah, of course. I love this question. Actually, no one's ever asked me this before. So the interest rate of a pool, whether you're depositing money and earning a yield from it, or if you're borrowing that specific asset and you're paying an interest from it, is determined based on something called utilization. And utilization really is just how much is borrowed divided by how much has been deposited into the pool. So if you deposit 100 ETH into the pool, let's just say you're the only depositor and I am the only borrower of Ethereum and I borrow 99 ETH in the pool, what would happen is utilization would shoot up to 99%. And that means that I, as Jane, will be paying a very high interest on this pool, on my borrowing, whereas you, Sarav, would be earning a very high interest on your deposit. And the idea is because we want to balance utilization both ways. In a sense, we want people to be borrowing and we want people to be utilizing the pool. But at the same time, if the pool is overutilized, meaning someone who's deposited can't take their money out because all of that money has been borrowed, that's not a great experience for depositors as well. So what we target as a protocol is we target an optimal utilization so that borrowers are happy to pay this interest rate to suppliers and suppliers are happy to earn this rate. And at the same time, they're able to withdraw their liquidity because there's liquidity available. I'm going to pause right here to see if you want to zoom in on any of the points.
No, I think these are fantastic explanations, and it's definitely a project that people should have a look at. But off recent, right? DeFi market, the curve attack. A lot of people sort of now crossing their fingers about the projection of DeFi's overall growth. So, how do you project DeFi till 2030? And could you also, because you're an expert over here, so could you also tell us about the security angle of your project post curve
Yeah,
attack?
definitely. I mean, like DeFi is still so incredibly young. And as we have seen time and time again, smart contracts are definitely a vulnerability that could, that could blow up across multiple protocols, even the most established ones. And I think there's no way to sugarcoat it, right? I can be here to say, DeFi is great, DeFi is wonderful, DeFi is safe. But at the end of the day, we're still in a very new field. And I would say anyone who participates in the world of DeFi should be aware of these risks before they go in. There are no guarantees anywhere, even across the safest protocols. Now, that being said, Rome isn't built in a day, and these things must happen before DeFi becomes mature. And I think as an industry, we're learning from all of our mistakes every single time. For example, if you look at reentrancy attacks and different types of attacks in the early days of DeFi, you see very few of these happening again. And auditors are also getting a lot more sophisticated. And I would say as an industry, the feeling of being able to get away with hack money is also a lot less. Like exchanges do work closely with law enforcement, and protocols work closely with law enforcement to ensure that even if funds are hacked, you cannot withdraw them and off-ramp them. Now, there are, of course, exceptions, but I think as an industry, we are learning and we are maturing. By the year 2030, which is like 7 years from now, I think that, I'm going to even go like a few years back. I think in the next few years, people will still need to learn to download a wallet and use ETH to transact and learn about gas fees. But it will get a lot more sophisticated. As we have seen with multiple projects, they have started coming out with their own app version of the protocol, so people could connect directly on their mobile phone and just transact. That's something that I didn't see when I first came into DeFi. When I first came into DeFi, I was a little shook because I was like, I do everything on my phone, but suddenly I have to go back to my browser. I keep having to go back to my Chrome extension when I have to make a transaction. It's almost like I'm going backwards in time. And now I do see there's a lot more mobile adoption coming in the world of DeFi. And in fact, it's not even like a Chrome page that I use to interact on my protocol, interact with a protocol, but there are literally dApps being built, like an application within iOS being built to cater to a specific use case. So I think by 2030, I think people won't even know. Like, I think the term DeFi is going to go away. I think what's going to happen is people are just going to look at different applications. They're going to be like, hey, I want to trade this. And then they're going to have a wallet on the back end that they connect to, and they're going to make the trade. So it's very much not going to be blockchain centric or wallet centric. It's rather going to be use case centric, where if I have a use case, I'm going to download this app, I'm going to use it, and then on the back end, it's validated by the blockchain.
So wouldn't that mean a lot of commodification, a lot of players coming to the game?
Yeah, and I mean, I think that's the hope of it, right? Because if no one's coming to the game and you have no competition, it means that there's no interest.
Okay, you're probably the first person to say bring in competition. Okay, that's interesting. Okay, final question, Jane. Top 5 tips for the average Joe to lower their gas fees.
Lower their gas fees. Yeah, it depends on different purposes. I think the first is just obviously transact on the layer 2, because gas fees are a fraction of what Ethereum L1 looks like. The second part of it is look for applications that have gasless transactions. And what I mean by this is I personally am a user of 1inch. I probably shouldn't be talking about different protocol when I'm talking about my own. But there are protocols that are developing their features around gasless or gas optimization, so that users transact either with no gas or with minimal gas. I think the third thing is actually look at the contracts and look at the number of gas each contract consumes, or each transaction consumes, because not every contract is created equal, and some contracts are a lot gas heavy than others. And then 2 more. Trying to think. Your question is on gas optimization, right? Or can I just talk about gas in general?
Gas in general, but if you can't give me 2 points, I think I can.
Layer 2. Yeah, I mean, I think that's really.
Let's do top 3 is good enough. The other 2 is subscribe to the Coin Republic and follow Zklend. There you go, ladies and gentlemen. That's it for today. Follow them. Where can they find you? Where can they be a part of this, your community?
Yeah, so our protocol is actually live on Starknet right now, Zklend. fully functional, audited, and formally specified by ABDK and Nethermind. So we've gone through the most extensive of security audits. But please try it out, especially if you're interested in Layer 2 and trying out the Starknet ecosystem. There are very juicy yields to be earned and for borrowing. But you can find us on app.zklend.com or via our Twitter, zklend, as well as on Discord.
Fantastic. And you already know where to find us. So there you go. All of your gas fee solutions on this podcast. Ladies and gentlemen, please let's bid adieu to Jane Ma, but let's also focus on her growth, because I make a pledge that I'm going to follow your journey off late, and I'm probably going to cover you more often. So thank you very much for being here, and let's stay in touch.
Thank you.